all here today, and we're honored by the presence of Keith Lampi, CEO of Inland. And Inland is the biggest and best thing in the DST space. They created the product, almost 26 years ago now?
Yeah, it was definitely over 20. It was the early 2000s.
Early 2000s. They were present at the creation of the product. The parent organization, their reputation for integrity in the commercial real estate space is legendary. We've dealt with them for almost a quarter of a century, and I can't recall them ever putting management capitalism in front of investor capitalism. I met Keith 25 years ago, right out of college. Him, not me. I'm an old piece of shit.
Technical term.
If there is ever an example of the good guys winning, Keith Lampi's it, because he is one of the finest, brightest young men I've had the good fortune to know in my life, and he oozes integrity out of every pore of his body. And he now sits on top of Inland, the biggest entity in the space and one of the biggest privately held commercial real estate companies in the nation. And so he is here to tell us how it's gonna be in commercial real estate, okay?
And to have fun.
And to have fun.
Do my best. Well, I'll say, I mean, that's a gracious introduction. I mean, it does kind of cut both ways. I started at Inland as an intern. This was 2001. Met Bob Smith when I got my first full-time job in probably late 2002, and learned a lot from him. I learned a lot of the business from and I think it was good perspective for me to gain, because it helped me learn how to think like the advisor, think like a client would think, and ultimately be, kind of ingrained with that client-centric mindset. So Bob's far and away my oldest friend in the business. We go way back, and he asked me to be here, and I would never tell him no. So thanks for having me.
It was like, you were renting, but, there's kind of, I won't call it a negative onus, but it's like you wanted to get into your first single-family home as soon as possible because you wanted to build equity. Do you think some of the negative onus that was associated with being a long-term renter is diminishing as young people find the convenience of being able to rent a single-family home? And it seems like this generation is really convenience-driven from a consumption standpoint. Do you see that changing?
I don't at all. I think it's only, and in fact, I see it getting more and more exaggerated. I mean, to your point, when I came out of school in the early 2000s, it was, the common theme was get. Not many people call me that anymore. You see the crow's feet here, but it was like rent until you don't need to. Go buy a condo, but don't throw your money away on rent. And I think that the generations that have followed, and think about some of the psychology that's maybe colored some of that judgment. I mean, a lot of kids saw their parents, their loved ones lose their shirt during the financial crisis, right? So home ownership, which was always buy a home and you'll never lose money, and that's the biggest, most important investment you can ever make. That myth was kind of...
Well, that's the thing, is the barrier to ownership has gotten so high. And like Keith's saying, and you commented, just to get a shovel in the ground, what's it cost you per door? And you hear the government wants units built. Well, we've got to build more housing. Well, you're not the ones to do it, number one. It's the private sector should be doing that, but I just see it's the experience of today for these kids. And I really sort of feel like the government doesn't want them owning real estate. I really, truly believe. I mean, that book, You'll Own Nothing, if you look at what's happening, and I sort of joke with Rob when we're doing the presentations, I feel like I'm aiding and abetting this shift from regional ownership, local people, to institutional ownership of these things, whether you're, like you're saying, whether it's a neighborhood that was built specifically to be rented, or you're talking about the building we're sitting here at, the occupancy, or we're talking about people doing conversions into, from office into residential. The housing is there. They start talking about what Musk talks about. Well, the population's starting to drop. So what do you do with all the buildings? What do you do? The whole thing is changing. All of it is. And the kids, I think today, they just, it's too much for them to get into. That initial, I mean, not that long ago, I mean, people that listen to our podcasts hear me say all the time, the first property Tom and I bought in Oregon was $23,000. Okay, that was not that long ago. It was 1990. And that was one of a bunch of stuff. I mean, you think about what you paid for the apartment building, that your first building that you paid, nothing for it.
Historically, manufactured housing was kind of looked down upon, but manufactured housing obviously is also going to be part of the answer. So what other things does Inland see in terms of how this evolves to accommodate people? And as it says, the barriers to renting are going away. I was talking to my son the other day, and because we just had a new stereo system put in the home, and I was bemoaning the fact that I'd gotten rid of all my CDs, and it's like, well, who owns CDs anymore? You just you go to Spotify, this, that, everything gets rented. And I said, yeah, but you're just renting it. He goes, well, what's wrong with that? Well, you don't own anything. And so, to me, that was just another manifestation of this. The anti-renting psychology is diminishing, and these young people are just fine with literally renting everything: music, cars, homes. So how does that, because what you're in buying real estate for the future, you're trying to anticipate consumption trends. So what do you guys see that translating into in a broader context?
I mean, I think that's the tip of the spear, right? I mean, the investment thesis is anchored on, really that shifting, changing sentiment, and it maybe sounds a little self-serving for me to correlate our thesis with demography, but in so many ways, real estate and demography and demographic trends are just they kind of are consistently have historically been in lockstep, at least when you're aspiring to find some semblance of stability and potential upside. And when we look at each demographic cohort, we're thinking about how not how we thought at that moment in time, but how the future is thinking, and how the future future generations will want to interact with the properties that we buy and that we manage. And it sounds like such a basic principle, but it does require you to get outside of conventional thinking, conventional wisdom, get outside of the four corners. Again, this is a technical, defined term in commercial real estate investing. If you take a real estate 101 class, you're going to learn about core sectors, core sector allocations. And core should mean the safest and the best, and there's probably a number of different synonyms for core. And those four sectors are retail, office, industrial, and apartments. And two of those four sectors have gone through systemic dislocation over the course of the past several years. So that, again, is a kind of a foundation and a principle that's led us to a lot of these non-traditional takes on how to invest in and how to find opportunity in commercial real estate. Housing is a huge theme we can speak a lot about, right? Because there are subsegments of how to look at the housing market, and how to look at where rentership is going to be popular and potentially undersupplied given some of the demand characteristics. But housing is just one element of our broader investment thesis.
So Keith, like with OZ or QOZ product, obviously you're keeping all that in mind when you're looking at what you're going to take on in that field space.
Yeah, really, the structure is secondary. We have public funds, we have private funds, we have tax solutions. So our DSTs, our 721 exchanges, and our QOZs are all tax solutions, and those are. That's a vehicle. That's the packaging. But the real estate thesis is consistent across each of those different structures, and that real estate thesis is, again, everything I just described. It's a mindset that the real estate market is evolving. Alternative sectors, once were considered niche, are kind of becoming. And maybe in the future, the term core gets redefined, because they're becoming more core. They're becoming more consistent with where, institutional capital formation is occurring, where a lot of the smart early movers and early adopters are placing their investments. And I really believe that's kind of the wave of the future.
So, I was talking with Dan Wagner. You're a gentleman.
Yeah.
And we were talking about some potential changes out there that the government's mulling over, and obviously they're always threatening us with 1031 with that. Want to drop it to the 500 per person per year. But if we look at that whole thing, one of the things he mentioned that really alarmed me was the potential change in the accredited investor limits. And I just look at it, and I mean, you think about the housing, and historically, somebody, as we've been discussing, you'd pile up your pennies and buy that house as soon as you could, so you're not just paying somebody else's mortgage, right? But as that gets to be out of hand or out of reach, if they talk to their financial advisor, the financial advisor always says, well, I'll go buy a REIT. Well, it's a stock, right? They don't get the benefits and burdens of ownership, and that's one of the biggest things, obviously, with your DST products. But if you start looking at that, if the average person can no longer buy a home, but they still want to enjoy the ability to go buy real estate, and we've got a situation where the accredited investor laws keep bumping up that minimum net worth, and they already took the house out of it. I think it's really a tough place for people. I mean, to have real estate that historically was one of the biggest things in somebody's investment life. You didn't think your home, you didn't really think of it as that piggy bank, but it is. And now you've got a whole generation that's not going to have that, and yet they're not going to have the benefit of any real estate. And it's a pretty interesting situation, I think.
It is. I mean, the accredited investor rule is something that has, I mean, think about it, the numbers attached to that, the $1 million net worth exclusive of primary, there really hasn't been a lot of adjustment for many, many years. And so I think the thinking around that needs to be reassessed or readdressed and maybe inflation adjusted. I understand that perspective. I think the challenge with it is that assumes that perspective at that point in time was the correct one. And when we think about, being a more inclusive society, being more progressive, limiting and assuming somebody's not accredited and sophisticated go hand in hand, right? The rules are supposedly, but those rules are in place because it's a private offering, and so we need to protect people that don't meet those standards from whatever we're attempting to protect them because they don't have the guardrails of a public offering, but that assumes that the only way somebody could be sophisticated is if they have a certain amount of money, and so there's a lot of debate around this, and I think there will continue to be, and it's a hot topic, so I know there's a lot of buzz, but
I just think it's tough, like Tom was saying earlier, with respect to management of the assets today. Management is such a huge part of ownership of real estate, especially when you start getting doors, right? You've got to have people that are your advocate, and so many of them end up the advocate of the tenants, right? Not the owners. And now we're wrestling with insurance too. Your ability to get insurance. I just look at it all, and just that ability for the regular person to be able to go out and buy real estate, and there's no accredited investor law for somebody else to go out and buy a rental house, and how much work is a rental house, right? I mean, it's interesting how they apply that accredited investor stuff to a certain group of investments. But you can go out and do this and that and all these other things, and there's absolutely no guardrail at all there. So I think it's one of those things that people need to be aware that it's out there, and who's really fighting for the little guy in today's world. And I've just gone so many years with you guys into the DST stuff, especially through these problem times. Who's better prepared to survive a downturn, some individual or inland private capital, right? I mean, it's got 6 decades of time in the business to understand that. And one of the things that Bob and I have talked a lot about recently too, you've got a number of people that have gotten into real estate after the last crash, whether we're talking about individual investors who've never seen a bad day, or some of your competitors that have never seen a bad day, right? And so if things do change, who's going to be there to help people out? And it's, if you haven't gone through, I always like to say, I'm happy to learn. I'm tired of being taught at this point in time. And this conversation Bob and I have had a few times, Mr. Smith.
It's, unfortunately, I think the regulatory powers that be in the financial services industry approach it that anyone at the retail level is guilty until proven innocent. And in some respects, that I think inhibits information flow. As you commented earlier, DST industry has been extant for a quarter of a century. It's now a multi-billion-dollar industry. It's successful, it's established, and we still hear all the time about, I didn't know about that. I didn't hear about that. Well, the reason you don't hear about it is because of the prohibition regarding general solicitation, and that's supposed to protect people. But I think in many respects, it makes it much, much harder from an information discovery standpoint for people to learn about this and then determine for themselves whether or not it's appropriate. So the point we make to people who are already in the real estate business, again, as you mentioned earlier, as an institutional investor, your job is to be anticipatory where that smart money is already going. And unfortunately, most of the time, retail investors are always a day late and a dollar short. And we've always felt the great thing about DST was it ups the ante for retail investors. Not only does it give them many more options from an ownership standpoint, but it puts them on the institutional side of the equation. And so if they're ever going to get in front of the curve, that's the way it's going to happen. And I think it's almost impossible for them to do it themselves. And so we feel very, very grateful that entities like Inland are in the business and putting as much time and energy into developing the business and trying to improve communication as much as possible.
Yeah, I mean, I think of so much of what we do, and you mentioned accredited and many of the private offerings and the private capital formation that's occurring, and I do think those are all kind of, that's a poster child example for access, right? Bob, to your point, providing Main Street access to what Wall Street has historically had exclusive access to. The latest iteration of many of the public vehicles does accomplish that as well. And David, you mentioned earlier that's you're buying stock and it behaves differently. But on the non-listed side, you're marking your value monthly to sort of provide perspective on what's it worth for the individual that's getting in each month, and what's it worth for the individual that's maybe redeeming. So in the end, when I think about everything that we're aspiring to accomplish with this investment thesis and bringing that forward thinking in terms of the types of real estate we interact with, the types of real estate we invest in and ultimately present potential investors with, it's all about access. It's all about democratizing real estate, right? Because 40, 50 years ago, a lot of the assets we'd buy, Main Street investors just couldn't touch, wouldn't have access to, and I think we've come a long way. I think the industry will continue to, but that's kind of our take on if I were to sort of score or try with a sentence or two to describe what our mission is, that's the mission. That was that's not my mission. That was the mission that I think the founders of Inland, Dan Goodwin, Bob Parks, Joe Cosenza, and Bob Baum, that was what they aspired to accomplish 55, almost 60 years ago. And talk about some foresight in terms of really being able to do something that hadn't been done. It's an exciting thing to be a part of.
We talked a little bit about technology and real estate earlier before we started taping, but I guess I'm sort of curious your thoughts when we start looking at a lot of that. I know there's different firms that jumped in the DST space that are just tech people, right? And I think some of the crowdfund business have been that way, and it sort of obviously dropped it down to floor of, I don't know, maybe crowdfund might be $25,000 minimum investment, whatever it might be. But you sort of see, the people, Inland's roots real estate. And you see a whole bunch of people, like I said earlier, that if they got in the business after the last crash, they've seen nothing but good days. But it's not how you're doing in those good days, it's how you do in the bad days that's really going to make you that good part of history instead of the bad part of history. You want the good story. And I just sort of feel like so often people just want to throw technology at things these days, and they don't really understand what they're getting into until they've been taught. And I think that historical perspective is one of the things that is very important for me, and I know it's something that you guys have, and there's only a handful of those companies that have that. So, you've been through this stuff, and you see sort of segments, changes on things, and you're going to have projects that you guys take on, but you're pretty bullish on the future and with what you're seeing and what you're working on?
Yeah, I am. I mean, you talk about the advent of tech, and it affects us all in a variety of different ways throughout our day-to-day lives. And I think real estate's always been a slower moving adopter of technology. But I think I think it's upon us. I mean, we're well into kind of the early innings. And I'm not just talking about real estate. It's from a financial services perspective, how business is done, and how just from a application and workflow perspective. I mean, we hear the word frictionless and ease of doing business, and I think technology can take us a ways from that. So, when you think about the growth in our industry, and I do think growth is good. I'm a competitive individual, and I think of competitors in a way that I should. They're competitors, but I also think increasing and growing the competitive landscape is healthy for the business as a whole. But when I think about how we differentiate and what we bring to the table, it's the kind of the old adage: you have to know where you came from to know who you are. And we've always been a real estate company, and hopefully you feel like that's consistent with some of my comments earlier. It's DST, 721, QOZ, this alphabet soup of acronyms. My comment earlier was it doesn't really matter. It's all about the real estate strategy. The real estate strategy drives everything else, and there are nuances and there are details within a subset of a product structure, or whether you're distributing your product through financial intermediaries or you're just investing for yourself. Different nuances exist, but at the end of the day, a real estate strategy has to be a real estate strategy first, and that's what's driving us.
That's what I struggle with personally, because I'm a neo-Luddite when it comes to technology. I'm a very late adopter, if I adopt at all. Whatever part of your brain, does technology, it's about as big as a walnut for me. And I see, because we tell our investors ad nauseum, it's all about the dirt, okay? And it's all about the people who are going to be buying, managing, and ultimately selling that dirt for you. So it's their strategy and the integrity of that strategy. And just like David said, see people throwing technology at capital formation when it comes to real estate, which nominally, I guess, does make it easier, but absent a coherent real estate investment strategy, that technology is worthless. And so we think it's very, very important for investors, whomever you invest with, whatever you do, to make the distinction, that most important distinction between the dirt, the real estate strategy. Is it there? How long has it been in place? How successful has it been? And the delivery mechanism. Do not put the technology in front of the dirt. Right. And we're seeing some of that happening in our space, and that concerns me.
Yeah, but tech's a tool. It's not the strategy, right? It's 100% agree.
That's why he's CEO, because he just said in like 5 words what it took me like 5 minutes to say. Okay, there you go.
No, it's.
Yours had lots of flowers, though.
There you go.
No, I just look at the world, and it's sort of interesting to me. We were talking about people that go full cycle on the DST investments. Obviously, we're on the West Coast in Oregon, and for future context, it's election day in 2024, so we don't know what we're going to wake up to tomorrow. But I'm curious, and my father-in-law used to call them on knotheads. Every time you elect a new group of them, everything sort of changes, and they all got their great ideas going forward. They did their white papers on it. So I'm just, I look at it, and I just see from our clients' perspective what they end up doing. 80+% of the people that buy into DST product, when it goes full cycle, they go for the ride. And the biggest complaint has historically been, I'm stuck with it to full maturity and full cycle, and then if you short cycle them, they're upset.
That's the supreme irony of DST, is because guys like Tom, they've been running their own stuff their whole life. So there's a control thing there. And once you finally get them over that control hurdle to hand the ball over to you guys and run with it. And that is the biggest hurdle. And that's like, well, the question is, well, how do I get out of this thing? How do I get out of this thing? It's like, it's going to blow up. It's radioactive. And as soon as they get in it, and then they get used to the mailbox money business and they've checked out, the last thing they want you to do is sell it. And so when you get to the point where, hey, we made a bunch of money on this, or we made money on this, we're going to sell it. It's a good idea. You got liquidity event. It's like, why are you selling it? It's a great property. I don't want you to sell it. It's like, Jesus, we can't win. Can't win. So yeah.
Yeah, I mean that speaks to the maturity of the industry, right? I mean, we have a couple of decades and several full cycle events, not only as a firm but also industry wide. And I always look at it as it's a proxy for how it's supposed to work, right? It's seeing it, taking it from the theory that we had 20 years ago and it now actually seeing it come to fruition. So, I mean, that is, buying. We're in the business of buying, managing, and selling. DSTs are a professionally managed engagement. 721s are a little different, right? I mean, 721 is a DST first, but it has an end game that is sort of a prerequisite end game where eventually it's going to be connected to a larger, more diversified portfolio. And again, that's not the right solution, or it's not the wrong solution. It's just a different solution, and that's what I love so much about how where we've gone as a market and as an industry is there's been innovation, thinking about the client and what a client might need, and what a client might maybe a client doesn't need just one thing. Maybe a client needs a diversified menu of different alternatives, and that's now applicable to, you have different strategies within sectors, you have geographic diversity, and you also have structures that accomplish different things, and that's,
So how do you like the 721, and you guys, how popular is that product for you? Because I look at it, and we're in a market, obviously, where seller finance is become sort of a necessity at times, and I feel as though so often people that will accept seller finance don't understand the tax consequences of their actions, right? I mean, they think they can do an exchange when the balloon payment comes in the future, or they don't. They think they're just going to pay tax on the principal payments as they get them. And, you've got both, but they don't understand the tax on, debt relief and depreciation recapture too at that point in time. And just the whole taxation of 721 is pretty cool too, how it flips it upside down. We've had a couple clients in the last 2 months, I think, that they came into us honestly terminal. So it was the end game that they were looking for that would allow the liquidity event, at least while we have stepped up basis in existence, right? We don't know what's going to happen, who wins, what happens with that. But it seems like it's another arrow in that quiver. It's a great solution for people that maybe want to spread the tax over time, but get out of the management, and they want that liquidity going forward. I mean, what kind of, as far as inland and what you're seeing, how's the pressure on that space? And why don't you actually maybe define exactly what the product is for people that don't? They're thinking, what's a DST? Well, what's a 721? We're going to get to it.
Yep. Yeah. So a 1031 is kind of the baseline, right? You sell investment property, and you can reinvest into another investment property through Section 1031 of the code and defer your taxes. That's a DST anchors on that tax provision, which was established in 1921, over 100 years old, old as dirt, almost. 721 is in the arena of securitized product. 721 it's not new, but it's really gained a lot of momentum here the past several years. And what 721 effectively allows for is a property could be contributed to a real estate investment trust, or a REIT, on a tax-deferred basis in exchange for operating partnership units, which act kind of like shares of the REIT. So what it offers the REIT is an opportunity to acquire assets without coming up with cash. It's a cashless transaction. What it offers investors is an opportunity to contribute their asset, enjoy the broader diversified benefits of the real estate investment trust, and maybe have a sight line to future liquidity. How you asked the question earlier, how I feel about it, how is it going? I contend it's the fastest growing segment of securitized 1031 exchanges. We're seeing more and more capital form around the structure industry-wide. This is our first. We're in the midst of our first. We've historically been a traditional DST sponsor, and we kind of got to the point where we wanted to be agnostic to structure. We wanted, we got tired of arguing the virtues of one over the other, and we decided, you know what, they're just different, and what might make sense for one person might not for the other, and vice versa, and all the way around. So, I'm really proud of the fact that we're the first 1031 sponsor to have both concepts represented in our product suite, and we put that question in terms of like how do you feel about it, or what does it accomplish for you? We put that in Bob Smith's hands, and he provides advice to his clients. And what's been so interesting, David, is what we've seen is a lot of investors. It's not all or nothing, and it was almost not what we anticipated, but we're starting to see advisors come up with ways to interact with the client that are completely tailor-made, to the product. So it's really kind of cool to watch.
So, Keith, I guess two quick comments. One is you've got to be buying into DST offering that has that. It's not a broad deal. You can't just say, hey, I'm going to pick ABC DST offering. If it doesn't have the 721, it doesn't have the 721 when it's purchased. And then two, if you're in that product, anyone that's bought into it, they are going for the ride. You can't buy into the DST and then elect not to go into 721 if it's a 721 option, not option REIT, but I don't know how you key that, I guess, on the initial investment.
There are iterations of this. I mean, there's some companies out there that have a 721 product, but there's a cash election. Or what we did was there's some complicated concepts that we're kicking around here, but trying to simplify the chaos and complexity was our objective. Yeah. So knowing we could be the first to have both represented, we made it very, very binary. We're a heritage sponsor. We're one of the pioneers in the traditional space. We're going to have traditional options for you. And if you do a traditional option, it's not going to be it's not going to be an OP unit type structure. And then we have 721 DSTs, and those, it's not a choice. It's not an election. If you go into that, your objective is to eventually, be uprated. Yeah. And I think that just makes everything easier and leaves less up for interpretation and trying to make it as crystal clear as possible. So that's our take, or our approach.
Thanks for the clarification, because I think a lot of people think, well, gee, I can just use that option on any of it, which clearly they can't. I think the other thing that comes up a lot with OZ stuff is people say, well, hey, I've got this piece of property in this OZ, I'm going to do that and take advantage of it. You don't do that. You've got to be party of a QOZ project to actually get the benefits of it. So I think there's a lot of misunderstanding in that space with that whole topic. But so thank you for humoring me on that.
Buddy, can you tell us, are you comfortable elaborating on those alternative asset types that you see becoming really more and more core all the time that you guys are focused on,
Happy to. So I guess taking them in just no particular order, student housing. Student's interesting. Student is, can be polarizing depending on what university pops into your mind when I say student.
Not Harvard.
And it's interesting, right? Because the student market there's definitely an element of haves and have-nots. We're students of the broader real estate markets, and we're considering and thinking about investment options. We dig pretty deep, and we use third-party research, and we basically use whatever we have access to educate ourselves. And what we observed is student preferences are consolidating around the Power Five, the big name schools with the big athletic programs, and it's become less in trend or in concert with where kids that are of age to apply to school. It's less popular to go to a smaller tier, small liberal arts school. And so, going back to my original comment, some people think about that small school and they think, gosh, they're struggling for enrollment. I heard they're considering maybe closing. And there is some of those dynamics in student. We are laser focused on like the Power Five, the Yardi 200, the top 200 universities nationwide, and what's going on within those those educational institutions is remarkable. Like surging enrollment, academic standards. I went to University of Illinois. I wouldn't have gotten in today just based on so many more kids are applying to those types of schools than had historically. They can only admit so much. So yeah, they're growing in enrollment, but they're turning away more and more students. Yeah, Oregon, any Big Ten school. We've got
beer girls and running. That was it. Okay.
Again, I'm looking at test scores and GPA standards. It's just staggering. Rob went to Ohio State.
If you did, you would have been kicked out.
I mean, it's so again, when I look at this from an investable perspective, there's durable demand there, and there's a market that's disrupted, and if you pick the right part of it, you should do really well. Construction starts halted from COVID. There was already a housing stock shortage on universities. And now they're not building as much as fast because of rates and because of inflation. So there are a lot of these markets are undersupplied, and they're begging for more supply because their enrollment's growing, and it could probably grow by more. I think the student housing sector is a remarkable opportunity. Again, it's a take on housing. I think it's got a long way to run, and we believe this whole consolidation of preferences around the big name schools is only going to continue. Again, this is one of those access comments. The institutions have been playing this strategy for 10 plus years. And our market, our retail and accredited market, just really hasn't had a lot of access to it. So that's that's one of the things that brings great joy to me, is that we're able to execute on our thesis and bring that access point to investors, whether it's in a 721 or a DST or an opportunity zone or a REIT. That's going to be a big part of our strategy. Senior living is another, there's a lot of, I talked about demography earlier, demographic. Our strategy is entirely demographic driven, and you hear, kind of catchy terms like the silver tsunami, and it talks about the baby boomer age, and baby boomers are living longer. And by the way, we talked about the stigma of rentership. The stigma of senior living is another phenomenon I'm seeing sort of evolve. I mean, many of these, we have an independent living heavy emphasis. We do have some kind of age in place concepts where senior living, it may have like 50% independent living, 25% assisted living, and then 25% memory care. But these are amazing assets. The last one we purchased, I had to sign off and get a liquor license transferred to me because they have open bar at the end of each evening. And I mean, you walk into one of these places and they look like a Class A apartment with a lot of the social kind of dynamics that you'd expect, and and make sure that when family comes to visit, everybody's like enjoying themselves and having it is very comfortable. So that sector's evolved pretty dramatically. Huge shortage and growing demand. Again, and it's starting to get redundant, right? But the recipe is very similar. And senior living is another take on housing. Manufactured housing, that's very fragmented, historically didn't benefit from institutional ownership. There's a lot of investor appetite for manufactured housing. In fact, we still see, from a return profile standpoint, the negative on manufactured housing is that's a sector that's really held its value. So cap rates are still remarkably low, even though rates have spiked some. And I actually think that tells you something about the durability of the sector. But again, it's a play on housing, affordability within housing, flexibility in as many of these are double as like second snowbird type communities, or there's a mixed bag within manufactured housing, but it fits the mold. It was historically considered niche, and now you're seeing the institutions kind of come to it in droves. So I mean, those are that's a quick rapid fire summary on the housing options. And then self-storage is a big part of what we do. We actually just acquired a self-storage company beginning part of this year. We have a majority stake in Devon Self-Storage, which was one of our operating partners. And storage, if you look at historic secular performance over a 25, 30-year period, it's been one of the best performers, hands down. It's just durable, consistent. it, not as photogenic as maybe a beautiful Class A apartment, but just continues to
Don't
kind of
have
do
the
its
rent
thing.
control issues.
Well, there's that. In fact, you actually don't even sign leases in storage. They're rental agreements. So it's not uncommon for a storage operator to raise rents a couple times a year.
I love that whole thing where you store $500 worth of stuff, paying $100 a month for 6 years. Yeah, I mean, it just,
Got an investor, and he was a big owner of, it was a generational thing. His father started buying mobile home properties and that kind of thing up and down the West Coast. And so he owned a lot of manufactured housing communities, mobile home parks, that kind of thing, which are incredible cash cows.
Yep.
As long as you don't mind collecting rent with 38 in your belt, you're in good shape, And so, so he calls us one day and he goes, "What do you got for self-storage?" I said, "Well, why?" "Well, I'm going to sell one of my properties." I said, "Well, why?" "They print money." He goes, "In my business," he goes, you always have your usual suspects who are always either late or they can't pay the rent. So I'm in the office one day and here comes one of my usual suspects walking. And I'm thinking to myself, well, what's excuse going to be this time? And he walks in and he said, "Hey, I'm sorry, can't pay my rent right now." He goes, "Why?" "Well, I'm tapped out." "Why are you tapped out?" "Well, I just spent all the money I had on my 3 storage units." And he goes, a light goes off in the little squirrel brain that this guy's shit is more important to him than where he lives. I am in the wrong business. What do you have in the way of self-storage? That's a true story.
Well, see, and that just covers two of our sectors. Now, I will say our manufactured strategy, you're typically looking at 3, 4, 5-star parks. So we don't encounter the same type of thing from a tenancy standpoint, but no, storage is great. It's been historically very insulated from macroeconomic turbulence because it's very life events driven, right? You may need to rent a storage facility because you are moving, because you got a new job offer, or maybe you got divorced and you need to put your things somewhere where you rent an apartment. What are the 4 Ds: death, divorce, dislocation, and downsizing. So, all of those things occur irrespective of a macroeconomic environment, whether you're in an upswing or a downswing in the economy. And I think that's why it's been such a durable performer. And I will say storage surged. Operating metrics, the fundamentals, the rent growth, it just absolutely surged post-pandemic. And we are starting to see things kind of come back down to earth and kind of normalize a bit. So I still like the sector long term, and we have a huge commitment to the sector. We've got about $1.7 billion in assets and aspirations to grow that. But that is one of those areas where if I'm comparing and contrasting like senior living, the rents are surging. They're making up for lost time, and then there's a lot of strong trend lines there. Student housing, same thing. Storage is kind of on the other side of that, and I think we continue to kind of monitor that as we look for opportunities.
I got a really good article today that I sent out to most of our investors on, the aging population, talking about, the boomers between what, the young end of it's 65, high end of it's 75, 80. And we're right in the middle of that now. And talking to some developers of senior living, we've been telling our investors that you look at the economic impact that boomers had on everything they moved through from a consumption standpoint, whether it was Air Jordans, McMansions, BMW, they spent every penny they had. And we're telling our investors now that these people are aging out and they will transition to some sort of managed or assisted living situation. We tell them, if you think baby boomers are going to spend one dime less on their lifestyle at the end of their life than they have all the way through it, you're badly mistaken. And so these things are going to go, from an amenity standpoint, seriously upscale. Just like you said, restaurants, open bar, all that kind of thing. So, and that, Keith, that's what we struggle with, because, real estate investors tend to be, conservative people, because they beat let's say we won the Lucky Sperm contest. They beat every nickel out of the ground with their fists, and they've had every scam imaginable run by them. So they're pretty jaded people. And so we try to get them psychologically, look, yeah, this has worked really well in the past, but the times are a-changing. Thank you, Bob Dylan. And this is what's going to happen in the future, in all likelihood. And that's what we struggle with, getting people through that transition from a psychological standpoint, in terms of, this is where you've been, and it's been very, very successful. But if you want to continue to be that successful, this is where you have to be, and they're going to be two different places.
Yep. No, 100%. And I think that's, it kind of says it all. I mean, I'll give you another example. Recent senior living acquisition. We haven't closed on it yet, but it's within pretty close proximity to a university, and it's heavy independent living. A significant component of our tenant base are professors. So think about that. These are. I mean, we're intellectual. I mean, they're teaching our college students that are also potentially renting from us and on campus, and then they've obviously been successful in whatever their previous role was, and they're posted up at an independent living facility after they kind of hold court in a lecture hall. I mean, it really does sort of like debunk the myth of, and I think that's really what it sometimes occurs. You say a sector, you say a strategy, and people get an image in their head that is that perspective that's created by whatever past experience they had, and it's kind of our job to help navigate our way through that, because and remind people that once upon a time, renting, if you're buying an apartment, there was a picture in your head that was, oh, you're an apartment landlord. People that rent apartments maybe present you with challenges, the whole stigma of rentership. And now we don't even talk about that anymore, because we've grown so accustomed to, how the apartment segment of the market has evolved. And that's what we're seeing with some of the niche or non-core sectors.
I think all you got to do is drive through the parking lot in the apartment building, and what cars do you see sitting in there versus the old days, right?
There's some of that, yeah.
Yeah, a little different than it used to be, certainly. I just, with respect to you guys and the investment stuff that you offer, it's sort of interesting to me, because historically people start off with doors. You go a few houses and they go in multi-unit, then they go industrial, whatever it was. At the end of their investment life, they go into a big box single tenant building. And you can see the different companies that have provided that product for people coast to coast. And now if you just look at Walgreens in the Bay Area, the number of stores, all those people were thinking, hey, I got this income over a great period of time, and I don't have to deal with it. But those things are wonderful until they stop working. And I just sort of look at the product you guys offer, where people are going, and just the DST space in general, and it really changes it, because it takes a lot of that, from my perspective, the risk out of where they're going. And I always like to say in life, you get to a point where you realize the most important thing in your life is your health. And then it's typically, I'll say, have someone to love and be loved by, but it's time. And so for that professor to be able to walk out of the classroom, go to that apartment and just not deal with anything, they want to go take a trip, lock the door, walk out, and go do it. It's pretty easy for them to move place to place, and the opportunity for them they don't have to sell a house to go.
We'd much rather spend time with that new co-ed than mowing the lawn.
I didn't say that. Bob said that, but that's why Bob's here. No. But anyway, I think it's time we get you out of here, probably. I think he's got a flight he's got to catch pretty soon. So any last comments you guys want to, sort of topics you want to hit before he has to hit the road?
Again, I just want to thank Keith and Rob for making this happen. And I just can't say enough good things about Keith Lampi. He's living proof that the good guys do win. So thank you for being you, buddy. You're the best.
Oh, thanks for having me.
Yeah,
both of you.
thank you so much for being here, and thanks for letting Dan help us out. The CCIM chapter is going to do the sort of legislative update in, I believe it's January 8th. So if you're interested in finding out about that, make sure you reach out to us. We'll make people aware of when that thing's going to be going on. But it'll be interesting to see what happens tonight or the coming weeks and what kind of changes we might all be facing going forward. So for now, it's just
Retirement.
We're done. What's the point? But thank you so much, Keith. It's great to have you here, and you've always been available to take care of things that we needed, and really appreciate the opportunity to have you here today. And it's always fun to work with Mr. Spidell and the rest of the Inland crew. So happy holidays.
You as well.